Welcome, curious minds, to another deep dive. Today, we're taking a fascinating journey into the world of finance, but probably not in the way you might expect. Forget the spreadsheets and, the complex algorithms for a moment, because we're about to explore something far more human and maybe, just maybe, far more impactful: the psychology of money. This deep dive is based on insights from a brilliant book that really gets to the heart of how our minds, our emotions, and, our personal experiences fundamentally shape our financial lives.
It's true. What's so fascinating here is how often we kind of assume money is this purely rational game, guided by cold, hard math and objective data. But as we'll uncover today, doing well with money has a lot less to do with how, intellectually smart you are and a lot more to do with how you behave consistently. It's really a profound shift in perspective.
Absolutely. Our mission for you, our listener, is to pull out the most important nuggets of knowledge from this material. We want to offer you a shortcut, to being deeply well-informed about this behavioral side of money, complete with surprising facts and hopefully more than a few aha moments that stick with you.
Precisely. This deep dive will help you not just understand what happens in the financial world, but why it matters to you personally, encouraging you to think critically about your own financial decisions and maybe understand the perspectives of others a bit better too. So if you're ready to peel back the layers, well, let's unpack this, shall we?
I'm ready. Our first big takeaway today is surprisingly comforting, actually. It's encapsulated in the simple phrase, no one's crazy. Now, you might be thinking, wait a minute, I've seen some pretty wild financial choices out there. What were they thinking?
Yeah.
But the book argues that what looks completely irrational, maybe even reckless to you, makes perfect logical sense to the person making that decision based on their own world.
Which, naturally leads us to ask, why is that? The core insight here is that individuals from different generations, raised with completely different values, with varying incomes, and importantly, living through vastly different economic times, they learn incredibly diverse and often contradictory lessons about money. What you've experienced firsthand, that carries way more weight. It's far more compelling than anything you just learned secondhand. Imagine someone who grew up during crazy high inflation, prices doubling every few years, versus someone who's only known low, stable prices their whole adult life. Their fundamental understanding of money, of risk, security, it'd be worlds apart, right?
Yeah.
Even if they're both super smart, their brains are just wired differently by their lived reality.
That's such a crucial point. And to really drive this home, the author shares these two starkly contrasting real-life stories. They're just incredible. First, let's talk about Ronald Reed, a humble janitor, gas station attendant from rural Vermont. His life was about as low-key as you can get. First in his family to graduate high school, hitched rides to campus, fixed cars, swept floors for decades, bought a modest house for $12,000 when he was 38, lived there his whole life, widowed, never remarried, main hobby was chopping firewood. Seriously. And yet, when he died at 92, back in 2014, he left over $8 million to his stepkids, the local hospital, the library, no lottery win, no inheritance, no fancy career. He just saved what little he could, invested it consistently in blue chip stocks, and patiently let it compound for decades.
Yeah. It's truly astounding, isn't it? Now let's widen the lens a bit and contrast Reed with Richard Fuscone. Very different story here. Fuscone was Harvard-educated Merrill Lynch executive MBA, had a wildly successful career, retired in his 40s to do philanthropy. People praised his business savvy, leadership, all that stuff. He lived incredibly lavishly, expanded his huge, 18,000 square foot home, 0.11 bathrooms, 2 elevators, 2 pools, 7 garages, cost over $90,000 a month just to maintain. But then 2008 happened, the financial crisis, high debt, assets he couldn't sell easily, too much leverage, and boom. Bankruptcy. His Palm Beach house, foreclosed. His Greenwich mansion, sold at auction for way, way less than it was supposedly worth. The contrast, it's just, stark.
Wow. So seeing these two examples side by side, what's the deeper takeaway? Is it really just save more? Or is there something more psychological going on? Something that makes Reed's story so rare and Fuscone so tragic, despite all his smarts?
That's a powerful question. It really moves beyond just, basic financial advice. What's truly fascinating and maybe a little unsettling is that this kind of outcome, where someone with basically zero formal training outperforms someone with the best education, the best experience, it's almost unique to finance. You just wouldn't see a janitor do a better heart transplant than a Harvard surgeon, right? Or design a better skyscraper than top architects. But it happens in investing all the time. It highlights that financial success isn't a hard science. There's no perfect formula. It's a soft skill, where behavior Reed's patience, his frugality, his humility, versus Fuscone's constant pursuit of more, maybe his susceptibility to greed. That stuff can completely eclipse massive education and experience gaps. It really underscores that our financial outcomes are often more about our internal operating system, than our external credential.
That's an incredible insight. It really makes you rethink what intelligence even means when it comes to money. And this stretches out to so many other parts of our lives, doesn't it? Our personal experiences with money, even if they're just a tiny, tiny fraction of what's happened globally, they shape a huge percentage. The author thinks maybe 80% of how we just intuitively think the financial world works. Someone who grew up really poor, for example, they perceive financial risk, financial opportunity in a fundamentally different way than a child of immense wealth. Their whole idea of security or what's even possible, it's just different.
Precisely. And this isn't just like guesswork. Someone who lived through high inflation, think Americans in the 60s and 70s, prices tripled when they were young and impressionable. They'll view things like bonds very differently than someone born in the 90s, where inflation's always been kind of low and stable. Their baseline financial instincts are just fundamentally different. We all walk through life anchored to these views about money that vary wildly, precisely because our personal experiences vary so wildly. It's a powerful lesson in empathy, really, for understanding how other people make decisions.
The book even gives this fascinating example with JFK back during the 1960 election. Someone asked him about his personal experience with the Great Depression, and he was honest. He said he basically had no firsthand knowledge of the hardship, coming from immense wealth. His experience of that time, hiring gardeners just to give them a job. His family's fortune actually grew. They had more servants than ever. Now, compare that to someone who lived through the sheer terror of losing everything, seeing neighbors starve. The author really stresses that no amount of studying, no history book can truly recreate the emotional power of that fear, that uncertainty, that scarcity, if you lived it. You can read about it, sure, but you won't have the emotional scars. It's like trying to understand being cold by reading about thermostats.
That's exactly it. And academic studies back this up. Research by Ulrich Malmendier and Stefan Nagel on consumer finances. It shows that how willing someone is to take financial risks depends way more on their personal history than on their IQ or education level. They crunched data from 50 years of the survey of consumer finances and found investment decisions are heavily influenced by the dumb luck of when and where you were born. Simple as that. Bill Gross, the famous bond manager, he openly admitted his incredibly successful career happened to line up perfectly with a huge generational collapse in interest rates. So to him, bonds looked like wealth-generating machines. But to his father's generation, who saw inflation just eat away at bond returns, they were wealth incinerators. Your personal timeline totally shapes your perspective.
It really does reshape everything. Okay, let's pivot slightly to something that often leaves people kind of scratching their heads. Lottery tickets. From a purely economic view, it seems, absurd. Americans spend more money on lottery tickets than on movies, video games, music, sports, and books combined. And here's the kicker. Who buys them? Mostly poor people. The lowest income households spend, on average, $412 a year on tickets. That's 4 times more than the highest income groups. And get this, nearly 40% of Americans can't even come up with $400 for an emergency, meaning the folks buying tickets are often the exact same ones without a safety net.
Right. From a purely rational mathematical standpoint, it seems completely absurd. You're basically blowing your safety net on 1 in a gazillion chance, right? But if we connect this back to this bigger picture of unique experiences and what the author calls the appealing fiction, the book offers this really insightful explanation. For many, buying that lottery ticket, it's the only time they can hold a tangible dream of getting the good stuff that others take for granted. We're talking about dreams like maybe a nice vacation, reliable car, good health insurance, sending kids to college without debt. They're not just buying a ticket, they're paying for a dream, for that brief, hopeful moment of imagining a totally different life. And if you're already living comfortably, it might be impossible to grasp the value of that fleeting hope for someone else.
That's a really powerful way to frame it. It forces you to look beyond just the numbers, right? To understand why these seemingly irrational financial choices are being made. The book really hammers home that financial decisions are rarely made purely with a spreadsheet. They happen at the dinner table, in meetings, all scrambled up with personal history, ego, pride, marketing, and just a swirling mix of really personal emotions. This basic understanding kind of sets the stage for everything else we'll talk about. It's a truly messy human thing.
Absolutely. Okay, moving on. Something else that's crucial to understand is that financial outcomes, they're often guided by forces kind of beyond our complete control, specifically luck and risk. These two concepts are so closely related, almost two sides of the same coin. You really can't believe in one without respecting the other. They both acknowledge that, not 100% of your actions dictate 100% of your outcomes. The world's just too complex for that. Too many moving parts.
That's so true. Let's look at that incredible story of Bill Gates and Ken Evans. Bill Gates had, truly 1 in a million luck attending Lakeside School in Seattle. This was one of the only high schools in the entire world with a computer back then, late 60s. Unheard of. This access let him just endlessly tinker, learn programming, gave him this huge head start. He says Lakeside is why Microsoft exists. Now his best friend, Ken Evans, equally brilliant, just as ambitious, maybe even the better student, shared Bill's business mind, tragically died in a mountaineering accident before they graduated. The odds of dying on a mountain in high school, also about 1 in a million. So you have the same force, same magnitude, luck and risk working in opposite directions, totally different life outcomes.
Which leads us right to this critical question. When you're judging financial success, whether it's your own or someone else's, it's almost never as good or as bad as it seems on the surface. We have this deeply ingrained human tendency, right, to attribute success entirely to skill and hard work, and failure purely to bad decisions or laziness. But the reality is just far more nuanced, more complex, often more random. It's easy to simplify these stories into neat little narratives, but the real world, it's messy, full of things you can't control. Benjamin Graham, the legendary investor, Buffett's mentor, he openly admitted his single biggest investment gain, Jayaco stock, actually broke his own strict rules about diversification. He asked himself, was it one lucky break or one supremely shrewd decision? Can we tell them apart? And his answer was basically, not easily. Because we humans just prefer simple stories over messy probabilities.
That's such a powerful observation. It reminds me of this really profound anecdote from John Bogle, the Vanguard founder. He was at a party, overheard Kurt Vonnegut, the writer, talking to Joseph Heller, who wrote Catch-22. Vonnegut points out that their host, some hedge fund manager, made more money in a single day than Heller had made from Catch-22 in its entire history. And Heller's reply, it just hits you right between the eyes. Yes, but I have something he will never have. Enough. That single word, enough. It's incredibly profound, isn't it? It makes you realize how many of our financial struggles aren't about lacking resources, but about this constantly shifting internal benchmark for what more even means.
Absolutely. That concept of enough, it's arguably the most challenging, but also the most liberating insight here. Because the danger of never enough is that goalpost just keeps moving. It never stops. If your expectations just keep rising with your results, there's literally no logical end to the striving. And that's where people often take bigger and bigger, often unnecessary risks. Especially that initial taste of having more money, more power, more prestige just increases your ambition faster than it delivers real satisfaction. Think about Raja Gupta, former McKinsey CEO worth $100 million, went to prison for insider trading. Why? He wanted to be a billionaire. Or Bernie Madoff had unimaginable wealth, committed massive fraud for even more. They threw everything away because they had no sense of enough. The goalpost was always moving, always just out of reach.
It really boils down to this incredibly concise piece of wisdom. There is no reason to risk what you have and need for what you don't have and don't need. Okay. Happiness, the author suggests, is actually a pretty simple equation. Results minus expectations. That's it. When we constantly compare ourselves to others, especially now with social media showing these amplified, often totally unrealistic versions of success, the ceiling for more just gets so ridiculously high that basically no one can never hit it. You end up in this battle for more that you can never actually win unless you just choose not to fight it.
And this leads us to a really critical distinction that often gets missed. Getting money. That requires one set of skills. It demands taking risks, being optimistic, putting yourself out there. But keeping money, that requires an almost opposite set of soft skills, a very different mindset. It requires humility, a healthy fear that what you've made can be taken away just as quickly, a commitment to frugality maybe, and a deep acceptance that, some of your success was probably just good luck. The single word the author uses to summarize real money success is survival. Longevity isn't just a nice bonus in investing, it's the absolute key.
That's a powerful point. Think about Jesse Livermore, legendary stock trader, early 20th century. Made a massive fortune in the 1929 crash, became one of the richest guys in the world. He was incredibly good at getting money, no doubt. But he was equally terrible at staying wealthy. Lost fortunes repeatedly, eventually took his own life. Now, contrast that with Warren Buffett. We study his investment returns endlessly, right? And fair enough. But the author points out something maybe even more profound about Buffett's success. It's what he didn't do. He didn't get carried away with debt. He didn't panic and sell during the, 14 recessions he's lived through. He didn't ruin his reputation with shady deals. He didn't burn out and quit early. Crucially, he survived.
Which brings us to a really crucial point. Survival gives you longevity. And longevity lets compounding work its magic. Compounding, the engine of long-term wealth. It only works if you can give an asset years and years, decades, really to grow without interruption. Think about that cautionary tale of Rick Guerin. He was part of Buffett and Munger's inner circle back in the day. Just as smart, but as Munger famously put it, he was in a hurry. He leveraged his investments with margin loans, and when the market tanked in 73-74, he was forced to sell his Berkshire Hathaway stock at the absolute bottom to cover his dates. Being forced to sell even just once at the wrong time can wipe out years, even decades, of potential compounding gains. Ironically, just having enough cash, enough liquidity, that can generate an amazing return just by preventing those desperate, badly timed sales in a bear market. It's the ultimate defense.
That story really hits home the importance of not being forced to sell. It also connects to another brilliant insight the author shares from his time working as a valet. He describes this personal aha moment. He used to dream of driving the fancy cars he parked, thinking they signaled, incredible success. He'd imagine, wow, if I had that car, people would think I'm cool, they'd admire me. But then he realized something. He never actually looked at the drivers of those cars. Not really. He only imagined himself in the car or how he would feel driving it. This is the man in the car paradox. People often want wealth to signal admiration and status, but other people often just bypass admiring them and instead use that visible wealth as a benchmark for their own desire to be liked and admired. It's a fundamental miscalculation, kind of like a social mirage.
It truly is. And this concept is absolutely crucial for understanding why we spend the way we do. Wealth isn't the fancy car you drive, or the designer clothes, or the huge house. True wealth is what you don't see. It's the nice cars not purchased, the diamonds not bought, the income not spent. It's financial assets that haven't been converted into visible stuff yet. The real value of wealth lies in offering you options, flexibility, freedom for the future. Being rich is kind of like a current income statement. It's about what you spend today. Being wealthy is more like a hidden balance sheet. It's income you didn't spend. It's the money quietly working for you behind the scenes.
Exactly. And this makes me think of that famous story about Rihanna, who apparently almost went bankrupt from overspending. Her financial advisor supposedly said to her, was it really necessary to tell her that if you spend money on things, you will end up with the things and not the money? And the author's take is basically, yes, absolutely.
Yeah.
Most people, deep down, they want wealth for the freedom and security it brings. But we're so conditioned by society, by marketing, to think that having money means spending it, that we completely miss the crucial restraint required to actually be wealthy. The only way to build and keep wealth is to not spend the money you have. That restraint is the definition of wealth. It's so counterintuitive.
Okay, so broadening our perspective again. If we think about actually building wealth, it turns out it has surprisingly little to do with your income level or the specific investment returns you chase. Instead, it has everything to do with your personal savings rate, how much you save out of what you earn. The author uses this great analogy from the 1970s oil crisis. The world didn't solve the energy crisis just by finding tons more oil, though we found some. We largely solved it by becoming vastly more efficient with the energy we already used. Our ability to use energy more efficiently actually more than doubled what we could do with the oil and gas produced since 1975. And that efficiency, that was entirely within our control, unlike the unpredictable luck of finding huge new oil fields.
That's a perfect parallel. So similarly with money, investment returns, always uncertain, unpredictable, full of doubt. But personal savings and frugality finance's version of conservation and efficiency, that's entirely in your control. And it's 100% effective today, tomorrow, always. It's strategy you can implement right now. And here's the beautiful part. You don't even need a specific reason to save. Saving is just this universal hedge against life's inevitable ability to surprise the hell out of you, usually at the worst possible moment. It's saving for the unknown, for the curveballs you can't even imagine yet.
And this leads naturally to a crucial point about the value of that saving. In our hyper-connected world, this increasingly competitive global economy, where intelligence and specific skills are becoming kind of like global commodities, right? Millions, maybe billions, competing for thought-based jobs. Flexibility becomes an incredibly powerful advantage. Savings provide that flexibility. They give you control over your time. And that ability to wait for genuinely good opportunities, to learn new skills, to find your unique niche without feeling rushed, to feel less pressure to chase competitors or settle for something less than ideal. That control over your time and your options, that's rapidly becoming one of the most valuable currencies there is.
That's a really compelling argument for building up that financial cushion. And speaking of what works for us, the book challenges this idea of being coldly rational with money. Instead, it suggests aiming to be pretty reasonable, Just reasonable. The author tells this absolutely wild story about Julius Wagner-Jarek. He won a Nobel Prize early 1900s for curing syphilis, his method.
Yeah.
He injected patients with malaria to give them super high fevers. Now we know today that fevers actually do help fight infection. They slow down viruses, turn on the immune system.
Right, and this is where it gets truly fascinating from a psychological standpoint. Despite the scientific evidence that fevers can be beneficial, we still universally treat fevers with drugs. We try to knock them down fast. Why? Because, well, fevers hurt and people don't want to hurt. Simple as that. It might be biologically rational to want a fever to fight infection, but it's definitely not reasonable when you consider human comfort and our unwillingness to endure pain if we don't have to. Similarly, in finance, mathematically optimal strategies. They aren't always what people actually want, or more importantly, what they can stick with long term. What they truly want, and what will probably lead to better real-world outcomes, is the strategy that maximizes how well they sleep at night. A good doctor's goal isn't just curing the disease, it's curing it within the limits of what's tolerable and reasonable for the patient. Finance needs to adapt to human nature too, not the other way around.
That's such a great analogy. Balancing the ideal with the messy reality of being human. Harry Markowitz, the Nobel-winning economist who basically invented modern portfolio theory, exploring that complex math between risk and return. He famously invested his own money not based on his super complex models, but simply to minimize future regret. He just split it 50-50. Stocks and bonds. Done. He was being reasonable, not perfectly mathematically rational. And the book argues it's okay to kind of love your investments because that commitment, that emotional connection, even if it's to a strategy that isn't technically perfect, that provides the endurance you need to stick around long enough for compounding to actually work its magic. If loving your investment keeps you from panicking and selling during a downturn, then that loyalty is a powerful edge that pure math just can't capture.
Precisely. And this ties right into another crucial piece of wisdom. Things that have never happened before happen all the time. This simple statement from a Stanford professor named Scott Sagan is profoundly important for finance. While history definitely helps calibrate our expectations, it gives us a rough guide of what tends to work over long periods. It is absolutely not a precise map of the future, especially not in a field like finance, where innovation, tech changes, and constantly evolving human behavior are just the norm. Relying too heavily on history can actually lead you into some dangerous, rigid assumptions.
That's so true. We tend to focus on averages, right? But we often miss the outlier events, the tail events that actually move the needle the most and have these massive disproportionate impacts. Things like the influence of just a few key historical figures, or events like 9/11, which, as the book points out, indirectly led to huge shifts in student loan debt through policy changes aimed at stimulating the economy afterwards. It's not intuitive to connect 19 hijackers to, $1.6 trillion in student loans decades later with a high default rate, but that's how a world driven by these tail events works. And we often ignore huge structural changes that make past data almost irrelevant, like the invention of the 401k in 78, the Roth IRA in 98, or the explosion of venture capital, which barely existed 25 years ago. These things fundamentally alter the entire landscape, making historical averages way less useful.
Which leads us to an important question, or maybe a realization. The right lesson from past surprises isn't to meticulously use those surprises to set the boundaries for future possibilities. It's more of a humble admission that, you know what? The world is endlessly surprising. You really need to guard against this profound failure of imagination if you just assume the future will look like the past, maybe slightly tweaked. Plus, the further back you look in financial history, the more likely you're examining a world that just doesn't apply anymore. Think about Benjamin Graham's classic investment formulas, full of timeless wisdom about value, absolutely. But do they work exactly the same way today? Not really. Why? Because competition increased. Technology made information instant and universal. Industry shifted dramatically. The underlying things changed. So the formulas had to change too.
Absolutely. So how do we even plan for a world that's constantly throwing curveballs? The book introduces this crucial concept of room for error. It draws lessons from blackjack card counting. When you count cards, you can tilt the odds slightly in your favor, right? But you never know the exact next card. So you need enough money on the table, enough of a bankroll to withstand those inevitable swings of bad luck, because you're playing a game of probabilities, not certainties. If you bet too heavily, even when the odds are slightly with you, one bad run can wipe you out completely, prevents you from playing long enough to realize your edge.
This is essentially Benjamin Graham's foundational idea of a margin of safety. He said it renders the forecast unnecessary, which is brilliant. It's not about being overly conservative or timid. It's about radically increasing your chances of survival at whatever level of risk you're taking. The magic is, the higher your margin of safety, the smaller your actual edge needs to be for you to come out okay in the long run. It protects you from the unpredictable. The author shares this wild, memorable illustration. A German tank unit in WWII. Defeated, not by enemy tanks or guns, but by field mice, eating the electrical insulation in their tanks, making them unusable. It's a perfect, if bizarre, example of how the most unforeseen, totally crazy, completely improbable things can do the most harm. Precisely because you just don't plan for them.
And those truly crazy, unthinkable things, they're often the ones that inflict the most damage, right?
Right.
Because you have zero plan for them. Which means maybe the biggest single point of financial failure for many people is solely relying on a paycheck to cover all their short-term needs with absolutely no savings buffer, no gap for the unexpected job loss, the medical bill, whatever. So the most important part of any financial plan is actually planning on your plan, not going according to plan. Saving money without a specific goal in mind, just saving for things that are impossible to predict or define, that's actually one of the most profoundly wise reasons to save. It's your ultimate personal safety net against the unknown.
And, in that same vein, it's absolutely vital to acknowledge that you will change. The person meticulously planning your financial future today, that's just not the same person who will be living that future in 10, 20, or 30 years. Your desires, your goals, your priorities, even core parts of your personality, they will inevitably evolve. Psychologists call this the end of history illusion, okay? We consistently underestimate how much will change in the future, even while being super aware of how much we have changed in the past.
Yeah.
We'll kind of think, okay, this is me now. This is who I'll be.
So, knowing that our future selves will likely be different people, what does that mean for practical financial planning? How do you plan for someone you haven't met yet? The book advises strongly against going to the extreme ends of financial decisions, like purposefully choosing to live on a very low income for years to save aggressively, or conversely, working absolute endless, grueling hours chasing a super high income. These things increase the odds of profound regret later on. The initial benefits of those extremes often wear off, but the downsides, they can become these enduring, nagging regrets. Instead, the advice is to aim for balance. At every point in your life, moderate savings rate, moderate free time, no more than a moderate commute, moderate time with family. This encourages endurance. It minimizes future regret because compounding works best when it's just steady, uninterrupted. You want to avoid creating these sunk costs where your future self feels like a prisoner, trapped by decisions your past self made, unable to adapt to new desires or circumstances.
That's really excellent advice for long-term well-being, not just finance. And speaking of costs, it's critical to remember that nothing truly worthwhile is ever free. Every good thing in life, a meaningful relationship, a fulfilling career, successful investing, it has a price. With investing, that price isn't just the dollars you put in. It's the invisible emotional price of volatility, fear, doubt, uncertainty, and regret. The S&P 500, for instance, maybe it surged an incredible 119-fold over 50 years. Amazing. But the price of admission to capture those returns was enduring countless days where the market was down 5%, 10%, 20% or more from its previous highs. Netflix stock returned, over 35,000% from 2002 to 2018? Mind-boggling. But it traded below its previous all-time high 94% of that time. That's the emotional roller coaster, the cost you pay.
What's truly fascinating here is how often we collectively try to get the returns without paying this inherent fee. Think about those tactical funds that try to jump in and out of the market to avoid the downturns. They often end up performing worse than simple buy and hold strategies because they inevitably miss the biggest up days too. Or look at GE under Jack Welch. They famously smoothed their earnings to avoid volatility, always showing consistent growth. Looked great for years, but eventually the bill came due. Massive losses later showed that the price is always paid, sometimes with heavy interest. So many investors try to get the upside without the downside, which, rarely, if ever, ends well.
The key, then, is this critical mindset shift. You have to view market volatility not as a fine you pay for doing something wrong, but as a fee, a necessary, unavoidable cost of admission for getting good long-term returns. If you see a market decline as a fine, your instinct is to avoid future fines, right? Which often means getting scared, selling low, abandoning your plan at exactly the wrong moment. You operate from fear. But if you treat it as a fee like buying a ticket to Disneyland, it costs money, maybe it stings a little, but you pay it willingly because you anticipate the awesome experience inside. If you adopt that fee mindset for market volatility, you'll have a much better chance of sticking around and actually enjoying the long-term magic of compounding.
And this leads us right into one of the most insidious psychological traps in finance, the bubble mindset, or as the book puts it, when you'll believe anything. Bubbles tend to happen when long-term investors start taking their signals, their benchmarks, their behavioral cues from short-term traders who are playing a totally different game. The true price or value of an asset. It depends entirely on your time horizon and your specific goals. What looks absolutely crazy and wildly overvalued to a long-term investor, think Yahoo, stock valued at a zillion times revenue back in 1999. That can make perfect sense to a day trader who just needs the price to wiggle up slightly by lunchtime to make a quick profit. They're playing completely different games with totally different rules and objectives.
And that's precisely where the danger lies. Bubbles aren't just about valuations getting absurdly high. They're often about time horizon shrinking across the board. As more and more short-term players flood into the market, influencing everyone else, when those rapidly rising prices start persuading all investors, even the normally careful, value-conscious ones, they can get completely detached from their own reality, their own goals, just by watching what others are doing and getting FOMO. It happens with consumer spending too, right? Our lifestyle choices are so heavily influenced by others, even if their game may be needing to maintain a certain image for work or just keeping up with the Joneses is entirely different from ours. We see how much other people spend, but we never see their underlying goals, their anxieties, or their actual bank balance.
So this brings us to this incredibly important question for you, the listener. What game are you playing? Defining your own time horizon, really understanding your personal financial goals, and, crucially, not being swayed by what other people are doing or their perceived successes, that is absolutely paramount. This insight helps protect you from what the author calls appealing fictions. Those things we desperately want to be true, especially when the stakes are high and we feel like we have limited control. Think about the person believing a folk remedy for a sick child, or the countless people who fell for Bernie Madoff's scam. They wanted to believe those impossible returns were real because they desperately needed a solution, or they wanted to feel part of that exclusive, successful club.
And finally, just a word of caution about how our own minds work. We have this tendency to form complete, coherent stories, even when we only have incomplete or conflicting information. The book uses this great illustration. Imagine an alien observing Times Square in, say, 2007 and then again in 2009. From its limited viewpoint, just seeing the bustling crowds, the bright lights, the busy shops, the general energy it might conclude the economy was totally fine, vibrant even. It would be completely unaware of the, $8 trillion in wealth destruction happening behind the scenes of the housing market and the financial system. Our own biases, often fueled by incentives or just our desire to confirm what we already believe, they profoundly shape our outlook. When we're blind to significant parts of how the world actually works, we can totally misunderstand why markets are behaving a certain way, leading to dangerous overconfidence. As the financial advisor Carl Richards wisely put it, risk is what's left over when you think you've thought of everything. And the hard truth is, you almost never have. So after all that, what does this all mean for your financial journey?
The final chapter of this book, it's called Confessions. And it doesn't really tell you exactly what to do. It's not a prescription. Instead, it offers these kinds of universal truths and really encourages you to find what works for you in your unique situation. It's a deeply personal journey.
Yeah, it's kind of like how a really good doctor shifted from just treating the disease to treating the patient, understanding that there's no single right answer in finance, no one-size-fits-all spreadsheet that works for everyone. It's crucial. Your financial decisions, they aren't made in cold, hard spreadsheets. They're made around your dinner table, shaped by your unique goals, your deepest fears, and your most profound desires.
Some key lessons to maybe take away.
Oh.
Embrace humility when you succeed and cultivate forgiveness when you fail. Because the reality is, it's almost never as good or as bad as it looks at the time. Strive to cultivate less ego for more wealth. Remember, true wealth is often that invisible asset. It's what you don't see. Manage your money in a way that genuinely helps you sleep soundly at night. Prioritize that peace over obsessively chasing every last fraction of a return.
And maybe most importantly, use money to gain control over your time. Because that freedom, that autonomy, that's arguably the highest dividend money pays. Be nicer, maybe a little less flashy in your interactions. Kindness and genuine connection bring way more respect and lasting value than any fancy possession ever could. And crucially, just save. Save for anything and everything. Save is that universal hedge against life's inevitable curveballs and surprises.
Remember to clearly define the true cost of financial success. View that market volatility, that uncertainty, as a necessary fee you pay for admission, not some kind of fine for doing something wrong. Worship room for error. Build it into your plans, because that margin of safety, that buffer, it's the engine of endurance that powers compounding over the really long run. Avoid those extreme ends of financial planning, because your future self will undoubtedly change in ways you can't possibly predict today. And perhaps most importantly, Define the specific financial game you are playing, and then commit to it. Refuse to be swayed or distracted by the actions or the perceived successes of other people who are playing entirely different games.
Ultimately, yeah, it's about respecting the profound, beautiful messiness of human behavior when it comes to money. There's no universal truth that applies to everyone. There's only what truly works for you, aligned with your values and your unique life.
We really hope this deep dive has given you plenty to reflect on, hopefully helping you make more insightful, more effective financial decisions by understanding the powerful and often overlooked role of psychology in building wealth.
Thanks so much for diving deep with us today. We look forward to our next exploration together. Catch you next time on The Deep Dive.